Good afternoon and welcome to another Fireside Chat hosted by Credo Wealth. For those of you that don't know us, Credo is an independent wealth management business founded in 1988 with around 3.7 billion in assets and over 6,500 clients across UK, South Africa and the rest of the world. I'm Ainsley To, head of multi-asset based here in London, and it gives me great pleasure to introduce our guest today. So Antti Ilmanen is a principal at AQR Capital Management, where he's the global co-head of the Portfolio Solutions Group. Prior to AQR, he spent 7 years at the hedge fund Brevan Howard and a decade at Solomon Brothers, now Citigroup, having begun his career as a central bank portfolio manager in Finland. Antti has also published extensively in academic journals and has won numerous awards for his articles in finance practitioner journals. He received the CFA Institute's 2017 Leadership in Global Investment Award, and his 2011 book, Expected Returns, is a must-read for any long-term investor. And I must say myself, it's one that I regularly notice on bookshelves in the background of Zoom videos of many prominent investors. So Antti, welcome.
Thank you. Thanks, Ainsley. Looking forward.
Yeah, and you're joining us from Germany at the moment, is that right?
Indeed. Yeah, home office, German wife.
Perfect. How are things over there?
Yeah, probably better than in many other places, but we've got our lockdown light going on as well.
So no gathering in large groups, or not even grocery shopping?
Oh, shopping is fine, and some sports is fine, and so on. It's relatively good.
Yes, I imagine we started our little lockdown light, if you want to call it, a week or so ago. So,
yeah.
So I thought I'd share with our audience the foreword to your book, which was written by Cliff Asness, one of the founders and the current CIO of AQR, and who I think you first met as a PhD student at Chicago. So he says, the first time I met Antti Ilmanen, I thought he was insane. I was right, but I was to discover quickly he was insane in a good way. And the whole foreword is a very funny read. But in those first few lines, he was really referring to your obsession with finance from a young age. So can you describe for us how you first became interested in finance and how you ended up on the PhD program at Chicago?
I will, but actually I do tell that. So I had spent 3 years of I don't know, blood, sweat and tears on that book. And I had just submitted it to the Wiley, and then I get this Cliff's draft, and I knew Cliff, so we were not yet working together. I was still at Brevan, and I was a little nervous how he would write, because he likes to shock, and I read those first lines and I started to sweat like a pig, and then it turned out nice, like it turned into a positive type of crazy. Anyway, so the funny thing is that I really wasn't interested in finance during my Finnish university times. When I got to the first job in the Finnish Central Bank, where I got this, I think, very interesting first job of investing the country's foreign exchange reserves in international bond markets, I really was hooked then. And that took 3 years, and then I got my second stroke of luck. And maybe here I say that, in everybody's life's big turning points, luck is so important. I just got triple lucky. I got invited to Chicago, accepted to Chicago PhD program in finance. The first year, I just felt that wonderful learning curve. I was accelerated. I had been investing as a practitioner, but then I learned sort of what I should have been doing, so the theory and empiria. So that was fantastic. And in addition, so there were, great professors. My dissertation advisors were Fama and French, like the stars in the field. Cliff and another later AQR co-founder, John Liu, were my fellow students, many other good people. And I met my wife, she was doing MBA there. So just sort of triple blessing from that. And that was my start to finance. And then a few years later, back to work.
And you also mentioned in the foreword you used to use Post-it notes a lot. Is that
just they are still here, and there's a couple of these. I have not given up. I tried Palm Pilot 15, 20 years ago, and I noticed that these still fit better for me. Yeah.
Fantastic. So before AQR, you also spent some time at Brevan Howard, which has traditionally had more of a discretionary approach to trading, and I imagine was quite a different culture and working environment to AQR, given that AQR stands for Applied Quantitative Research.
Yes.
Were there any aspects of your experience with discretionary traders that shaped some of your research from a systematic investor's point of view?
Yeah. Well, I think it certainly has given me both the earlier Salomon Citigroup role and Brevan Howard. It gave me, well, I'd say better understanding of the discretionary side of business than most colleagues would have in AQR. So I think that has been helpful. But more generally, like some contrast there. So certainly at Brevan, I was sort of the cultural misfit. We had some systematic traders, but most people were discretionary traders. Whereas when I came to AQR, then later it was my natural home, and I was with sort of more like-minded people. Again, both are great places, but so that was certainly the biggest difference. Another, I think, cultural difference is sort of with incentives. At Brevan, like with many hedge funds, there's you eat what you kill. You make money from your own trading book, and with AQR it's much more collaborative, and we are also much more public, like sort of not as proprietary. When I was at Brevan, I wasn't really talking to clients at all. Now it's partly a different role also, but here I write, I speak in conferences, and I talk to clients about their challenges. So I think that's different. And last thing I want to highlight of the differences is sort of horizon, or that like a macro hedge fund, then Brevan Howard certainly focused on what's happening right now, what's a tactical opportunity here, whereas AQR is much more about long horizon good investing, find out strategic good ways of investing, which hopefully work out in our strategies, but they are also useful discussions, I think, for other investors then.
Perfect. So going back to expected returns, and again in the forward, Kvasnes also jokes about having you killed for revealing too many secrets in the book. So we'd love to dive into your framework. Where do you start when looking to determine the expected returns of an asset or an investment strategy?
Yeah. I think especially for major asset classes, I say that there are three big anchors that you want to look at: historical average returns, current market conditions based on yields, valuations, and forward-looking metrics, and something from theory. Actually, theory gives rather little because, okay, risk should be rewarded, but that doesn't tell how much, and it really doesn't give too much extra there. So it's between the first two. If you think that expected returns are pretty constant over time, you want to get a long-run history and look at that average return, and that's sort of the best you have. If you think that expected returns are time-varying, you want to then look at these current market yields, valuations, maybe some other metrics, but those are the most important things. And so if you look at the current situation, so you can look at long run equity returns over cash might be 5-6%, but when you look at forward-looking metrics, it could be somewhat lower than now in this situation. Though it's not that much lower because I said over cash. The cash is so low that it makes any excess return currently look pretty good, even though total returns are miserable, as we'll talk about later.
Perfect. And then starting on sort of long-term historical averages, and you look at many different assets and strategies in your book. Are there any sort of counterintuitive results that you think are worth mentioning when you scoped across the world?
Yeah. So I think across asset classes, or then for asset class premia in different countries, the evidence is surprisingly consistent. The risk tends to get rewarded. Positive equity premium, positive bond premium. There's not many markets with credit data, but there's some positive reward. So sort of those premia tend to be positive. It's when you get within asset classes where things are interesting. So obviously there are some styles, value, momentum, carry, but especially most important sort of puzzle is the defensive style. So while across asset classes, riskier assets have been earning more in the long run, within asset classes it tends to be flat or even inverted. So more boring investments within asset class, lower volatility, lower beta, higher quality stocks or some other bonds, or this works in many places outside finance. Like you can go to racetrack and look at long shots. So the long shot bias is sort of similar story. Boring things tend to do surprisingly well, certainly in risk-adjusted terms, but often in just raw returns. And why they outperform the more speculative brethren has been studied quite a bit by academics and practitioners. And I think two main explanations for that are sort of leverage aversion and lottery preferences. So those speculative things that have disappointingly low returns tend to be the proverbial lottery tickets in financial markets, and we overpay for them. And we also overpay for the embedded leverage that such investments give compared to the boring ones. So that's I think the best way to reconcile the puzzling thing, that risk doesn't get rewarded within asset classes in the long run.
And in terms of, obviously, just looking at the data is one angle of it, as you've touched on, the theory can be quite important in terms of why this is expected to sort of continue into the future.
Indeed. So that's why after telling the empirics, I was just going into those stories, because if you only had empirics and it was totally puzzling, you would be more suspicious that, okay, so this probably cannot last. Though it is interesting, so I'll just throw that with these sort of long short factors, it is common for some investors to say that only if there's a good risk story, we believe that it can continue. I mean, I think at AQR, we do think that some of these more behavioral factors, they can also sustain in the long run. Partly they just become risk factors when they get their own bad windows. So it's not so easy to stick with them with a few bad years. And there are things called limits of arbitrage which prevent investors, I think, from taking them away. But the most important thing really is that none of these, whether it's asset class premia or style premia, financial markets don't offer these very easy strategies where you can count on making money year in, year out. So that's a risk with anything you do.
And you did class the two sort of approaches to explaining different risk premia, the behavioral side and the risk side. In your opinion, is there a more weight that should be placed on one or the other, and is one more persistent than the other?
Yeah, I think certainly the first thing to say is that both matter. So and then it's just where do you see one mattering more? I think with equity premium and certain carry strategies and so on, the risk story is easy. But when you think of that defensive strategy or momentum strategy and partly value as well, they smell more behavioral. And I would say that I have become over time giving more weight to the behavioral arguments, because many of the risk-based arguments are catered or tailored for one asset class. It's a story somehow, let's say, within stocks. But when you look at the evidence, these ideas have worked in many different asset classes. And this sort of pervasiveness of how their long-run success is so robust in different asset classes suggests that it's not asset class specific story, it's a broader story, and the broader story is sort of the behavioral explanations tell a better broad story. Okay.
Perfect. And so maybe before moving on to sort of the current environment and what the outlook is for investors who also invest in traditional sort of discretionary strategies and those, do you have a similar or separate approach to making long-term return expectations for those type of strategies?
Yeah, well, two things. One is that, so first I would be humble. So just like, we tend to be overconfident, and certainly like if we pick managers, we expect them to outperform. We wouldn't otherwise pay those higher active fees. But historical evidence is not so great. So I think a reasonable approach would be just to figure out, basically assume the benchmark return and nothing else. And anything that comes on top of that is gravy. If you want to assume something more and you have got some ambitious forecast, I would say cut it in half, cut it again in half, and then you have got something that's sort of realistic. So I would certainly be cautious. Then another thing maybe to mention in this context is that even if you are a discretionary investor who don't sort of believe or use these factors for your portfolio in trying to make your portfolio systematically better, you may still use them for demystifying your active managers and your overall portfolio. So like we've done, I think, nice studies over time where we have demystified some superstars. The most famous story, I think, is the most famous superstar, Warren Buffett, where the evidence basically shows that his value added is not really coming so much from value for the world's most famous value investor, but more from the quality and defensive low beta type of tilts, where he's done so well. So that's one example. We've done similar things with Lynch, Soros, Bill Gross, and so on. And then you can look at even the whole hedge fund industry, where the first thing you find out is that, well, it wasn't really absolute return industry. There is decent equity correlation, and there are some momentum biases, small cap biases. Actually, the one thing that hedge fund industry has tended to get wrong, they've been on the wrong side of this defensive bias, and defensive style did very well last 10 years. Being on the wrong side of that hurt hedge funds. But again, you get better understanding of your individual managers or your broader tilts, I think, if you study these factor exposures, even if they are not sort of your cup of tea for enhancing your portfolio. Better understanding, that's always good.
And yeah, just fleshing that out for our audience, a factor strategy is almost a long-short strategy where you go long a certain characteristic, like cheap securities, for example, and you short the expensive ones to isolate that effect.
Indeed, and let me just say that you can do it long-short, so that would be the alternative risk premia type of approach, but you can also just do them long only, tilting within your long portfolio. So with the defensive strategy that we said, so you can do it long short, or you could just say that if I can earn the same equity premium by taking less risk, buying more boring stocks, that's good. So that's a long only version of the same thing. So again, both are applied in practice, and
fantastic. So given the framework that we touched on, what are your views on current prospects for investors on a global basis at the moment?
Yeah, well, low across the board, and I've had that view for quite a while, and I'm not alone. It sort of comes from these yield-based approaches, and in some sense, I've been humbled with that because the rich things have gotten richer when yields were falling, and again, when even this year now we are sort of lower for longer, and I think the good way of thinking of this is that almost any investment that you make, gold may be accepted there. So you can think of it as expected cash flows discounted by some common part of a discount rate, riskless rate, and some myriad risk premia that differ across assets. And when that common part is so low, and clearly it is at all-time lows, like multi-millennial lows today. So when it's so low, it means that all assets are discounted by low discount rates, even if the additional premia were sort of at long-run averages. So when that's the case, it means that everything is expensive today, and you should expect lower returns sort of from carry perspective. I don't even assume sort of mean reversion that they have to normalize, but just lower starting yields for anything. And it's not only bonds, it's most visible in bonds, and that's why people sort of know it in bonds, but it's also true for equities and even for illiquid assets, where it's really hard to get some good yield data. But if you get yield data, I promise that yield data will say that today's starting yields are well below historical average because cash is so low. So it's really cautious view across the board, and maybe so I add to that if you then take the contrarian approach, which so you think about mean reversion, which you don't really have to, like you get already bad enough, bearish enough view then with this low expected return, but from sort of income side. But if you think that there's going to be some mean reversion, then that mean reversion would suggest that the strategies and assets that did poorly the last 5-10 years, they should be doing better. And such contrarian signals would then favor really the things that we don't like right now. So assets that were sort of inflation oriented, so many commodities, not gold, but almost most other commodities, emerging markets compared to US equities, within asset classes, most obviously value stocks versus growth stocks. You are saying that they have become even cheaper as time has passed.
So it maybe going into some of the nuances, low returns across the board, mainly because of these sort of forward-looking yield measures, and then on top of that, if we're assuming that some long-term averages apply for, say, profit margins in stocks, for example, and those profit margins come down, then that's another further depression on sort of argument.
Yeah, and it can be. So there are many. Once you start to look at sort of decomposed equity returns, it could be just valuations that you just say that, let's say, so-called Shiller price earnings ratio should go from its 30 level to some historical average. Maybe not the 17, which is long run, but some mid 20s or something. So that would be bad news if that happens. then separate from that, like you said, there can be profit margins. There you can basically think about sales growth or profit margin and other ways of decomposing the equity return. And all of those may show some mean reverting characteristics, and then you'd be more cautious. I think it is difficult to tell a very bullish story. I mean, the bull story really comes from it. Okay, but yields are even lower, so equities, in an absolute sense, don't look great, but they can be justified by the low yields. And again, I sort of buy that when I say that. Then let's not assume mean reversion. Let's just say that the low yields drag also equity expected returns lower, and the same is true for many other assets.
Perfect. And are there any sort of global nuances? So we often think we're quite focused on a global basis, but a large portion of that is of course the US, given the market cap.
Yeah, well, I think US equities have been on the expensive side for a long time, and value signals would have told that you should go away. So I would underweight US equities, but I also know that that's like the market direction and like the growth versus value that has been unprofitable trade for a long time. But so from US favoring Europe or even more certain emerging markets, I think is a pretty natural trade from where we are. I feel pretty confident that for 2020s, that's going to be a good trade. I don't know whether it's going to be a good trade for 2021, but for the next decade, let's have another conversation in 2030.
Yeah, and just quickly in terms of other asset classes, so on a forward-looking basis, like you say, yields are most intuitive in bonds and somewhat intuitive in stocks. How, in terms of the forward-looking measures used for things like commodities and real assets, maybe you can touch on that.
Yeah. So first, so commodities, it's actually quite difficult to get forward-looking measures, and so in particular, we find when we study the predictive ability of roll or valuations, they don't predict too much for the next sort of 5-year ahead returns. So, but if valuations did predict something that after the poor performance of the last few years, that would be a good story. That would tell that besides the long run commodity premium, which we count as something like 3% for a commodity index, there could be something more coming from that. So I think that would be a mild positive. When it comes to private assets, I do think that most of them are on the expensive side. Again, they do tend to have some advantage over public market assets. But for example, if you look at private equity versus public equity valuations, there used to be a big valuation gap between them, and that has come down pretty much since Yale model became popular among institutions in mid to late 2000s. There's been limited gap, and it's nowadays when private equity is so popular that there really seems to be almost nothing there. So forward-looking metrics would not tell you that you should expect big outperformance from those types of assets. And with real estate, for example, like you can look at, I think they're maybe the spread versus treasury and so on is pretty normal, but it does mean that you look at the yields on various real estate markets, they tend to be at their sort of all-time historical lows. So the picture doesn't really get better. To be clear, so when I'm saying that everything is expensive, the message is not let's do market timing and let's go to cash. I forgot to say the lowest return of all is from cash, really, like when you look at this income. So there's big negative, depending on the country, but in many countries there's a clear negative expected return, sometimes nominal, but certainly real, coming from cash. And then it's a matter, if you want to do market timing and go to cash, how patient will you be if the market doesn't obey and fall very quickly once you have done it? I do think that the better approach is to basically invest, sort of diversify into many expensive assets, hold your nose and diversify. And in general, I think the best answers for investors to deal with this situation of low expected returns are not market timing, but it is raising expected returns by raising equity weights or going to illiquid assets or going to these factors or alternative risk premia. And the sort of the challenge is so big that if you really want to get something close to what markets used to give in the good old days, you may want to do all three rather than pick one of them.
No, it makes sense. No, it was exactly my sort of next question in terms of obviously expectation means something in a mathematical context than it does to investors with asset managers. So yeah, we have to be careful on the expectation side. And you mentioned the Schiller Cape, for example. That's obviously things are expensive, but they have been for a long time, and using that as an indicator for market timing is a bit more difficult.
Yeah, and there maybe I say so. We've done lots of work. My book was still quite positive on. Had I think positive spin. It used the word humble, but it was still more sounded quite positive on this sort of contrarian market timing. The more we have done research on that, the more we have gotten the message that when you do contrarian market timing, there is this cliche that you tend to be early, and early equals wrong, and it just shows up in equity timing, in duration timing, in credit timing, and you sort of get there too early, and then you suffer capital losses. Even if you stick to the position, sort of the round trip doesn't turn out to be very good. So long run performance of contrarian market timing is pretty modest. So we are quite humble. We'd say that if you do market timing, do it humbly, sin a little. We don't say don't sin at all, but sin only a little, and then don't do it just with contrarian, but combine those valuation signals with some momentum and macro signals and so on, so that you get a diversified base for your forecasts. But the humility in timing is sort of the key.
No, absolutely. And you touched on asset classes, and we'd spoken briefly sort of about value. So as you mentioned, it's been well documented that value as an investment style has been out of favor for as long as a decade on some measures. So in your opinion, is value investing dead?
Yeah, I just thought about that this morning. So we had actually 2 very good days for value now early this week, for stock selection value. And one shouldn't look at anything with, I say 2 years is too little, 2 days is a joke. But on that light spirit, I do say that if value investing is dead, I am reminded of Michael Jackson's Thriller video, if anybody remembers, where those corpses come from the grave and then they start to dance in the graveyard, because that's what we had for a couple of days. And again, it's way too early to say now whether this is going to be sustained. And it's, by the way, frustrating for systematic investors who are diversified, who we look at lots of signals. Value is just one of those things. And then when value recovers, that tends to hurt momentum. And so this kind of sudden turn is not very helpful. You need a sustained move. And so we are certainly crossing our fingers for a sustained move now. We don't know whether this is the final, the big rotation happening now, but it certainly is due. So for context, when we look at historical performance of value stocks versus growth stocks, there has been positive reward for value investing over the last 50 years or 100 years or even 200 years people look at. So it really is. And then you go to other asset classes and you find that value works. But there can be some relatively long periods when value disappoints. And depending on how you look at it, our way of looking at it, it has had really 3 bad years. Some other metrics would say 10 bad years, or 10 plus. So it is among the longest and worst value drawdowns, certainly, that we have seen. So historically now, last few years have been really bad. But the flip side of that is that then the forward-looking opportunity does look exceptionally good. And so we do think that this is something that investors should consider. At least they should consider sticking with it. But the flip, so sort of, what's the counter story? The main counter story why value has done so poorly is the idea of the tech stocks and the FanMags and others. And there, I would say, so we wouldn't be too critical on FanMags, because they do have many have their profits and they got their moats and so on. We'd be more worried about the FanMag wannabes, which have sort of neither. So the pricing of those, I think, is much more speculative. And by the way, our boss, Cliff Asness, so he looked at this year, how does the value opportunity look like when you take away tech stocks or when you take the mega caps? And he found it looks pretty similar. So it's not only that story of the FanMags. So somehow value is really out of favor. Out of favor stocks are doubly, so it's sort of squared effect that they are. So the opportunity, the valuation gap between value stocks versus growth stocks is as big as it's been, maybe bigger depending on the metric. sort of competing there with the dot-com bubble around 99, 2000, and in many metrics it looks bigger. So we do think it's a good long-run opportunity, but there is, of course, a risk that what we have seen last few years, this structural change, physical to digital, has got more legs. So clearly that's part of what's going on here, and we don't, we are looking at the possible catalysts, but we just think that big valuation gaps make it likely that sometime there's going to be this big move. Is it now with the election, with some rate moves, or with the vaccine or whatever? Do not know what's going to be the catalyst, but we do think that the opportunity is exceptional, and so we would recommend trying to stay with it, or even take more positions if investors have got the guts, despite the disappointing recent performance of value stocks.
And you mentioned sort of a frequent question that investors have when it's something like value investing that's over the very long term has worked, but is having a difficult recent period. And normally it's the question always, well, is this time different? Which is famously probably one of the most dangerous phrases in finance. Yeah. Do you have any and you mentioned a few things there, but ways of stressing and testing whether this time is different or not?
Yeah, well, I think it's fair to say again that contrarian strategies such as this stock selection value, they are always short a structural change. If a structural change happens, then you probably lose while it happens, and then you might not expect that, you shouldn't expect that you get all of your losses back somehow. So that may be, but it is in the nature of markets to take these things too far. And at some point you are too far. And again, our best judgment when we've studied very carefully, like sort of various aspects, what's been happening, whether it's on fundamentals or whether it's on the flow front and so on, it does seem that in 2020 we are now in that excess side. We would say that it is a bubble, and again, we don't know where that's going to end, but at some point there should be very attractive correction then on that. And so again, this is a can't say when and can't guarantee that, but it is ex ante one of the best looking opportunities, even if there has been a structural change. It may have already been far enough as it is.
Perfect. So we're in terms of and sort of slightly tangential, but you mentioned momentum investing, and then momentum as another sort of factor that tends to work across assets and asset classes. But one basic error sort of we noticed, and has been documented by many academics, is many investors tend to chase performance, something that's done well recently. So blindly investing in something that's done well, that they've heard about or read about in the news, is in terms of the subtle differences there between performance chasing and momentum investing. Maybe.
Yeah. I think it's very much about the horizon. So basically, academic research shows that things tend to trend, whether we are looking at between assets momentum within equity markets, so buying winners versus selling losers, or directional trend following, just one asset class at a time. In both cases, there is momentum or trending tendencies up to a year, and after that, things tend to move to the mean reverting side, and so then the criticism really for investors return chasing is not in general that they chase returns, but that they chase returns at 3-year horizon, so something like that. So Cliff, our boss, has put it succinctly: investors act like momentum investors at reversal horizons, and that's damaging their long-run wealth. So I think again we say, by all means, chase returns for a few months, but don't do it over multiple years, which is a typical performance evaluation period, and tends to hurt then long-run performance.
Makes sense. So it's sort of switching gears a little bit again in terms of value investing and the debate there, but for a number of other factors. One issue that plagues many fields and not just finance is the so-called replication crisis. That many of the results in academic papers aren't replicating out of sample. So what are your views on this, and any sort of possible solutions for that?
Sure. So there are studies which show that there are hundreds of factors that have been studied, and by now it probably would be more. And so and that's academic studies, and then there would be more by practitioners and so on. Ultimately, we actually think that when you think of umbrella concepts, there are not so many factors out there that, there are lots of different value factors, lots of different momentum type of factors. And with umbrella concepts, I think like these things do become smaller. But again, I think it's fair to really worry about overfitting data mining, and that therefore out of sample results will disappoint. But we do think that, and the studies show that these classic factors that I've mentioned, which have got the most persistent, pervasive, robust evidence over time, out of sample, in sample, in different markets, they have easily survived those replication studies. Actually, those studies tend to say that, again, value, momentum, defensive, pass with flying colors, liquidity type of signals have often done poorly, and that would be actually sort of my suspicion that also in stock selection, the liquidity type of signals won't do as well. And then there are, I would say, the more complicated strategies you think of, the more you should worry about this kind of overfitting feature, and then caution. But otherwise, so I think given the evidence how well these things have worked, and now I want to qualify that when I say that they work well, it means that the long run evidence is good. It's still, like I would say, value has done well, even though it has really sucked for the last few years now. But the long run evidence is pretty compelling when you look at long histories and different asset classes and so on. It's sort of hard to say that those last few years have now totally overwhelmed the positive long run evidence. And the same thing again for a couple of others, momentum, defensive, and so I think those have been robust in those studies, and sort of, let's say, my faith certainly remains there. They will have their good and bad times, but a good ex ante expectation is that they will continue to deliver in the future, even when people know about them. Partly because they will get these ugly windows, and then people bail out of them, and that sort of sustains the long run profit potential.
I think there's the saying that if there's no pain, there's no premium. So
that is, I think, one of my favorite blogsters has got, I think, this one.
So and you mentioned liquidity is one that's sort of flagged up in terms of replication, and for the audience, the conventional wisdom is that you should get an expected return premium if two assets, for example, are similar, but one has slightly less liquidity, then you should be rewarded for that. So in terms of the work you've done, do you see an illiquidity premium, and how's that fit in with the literature as you mentioned?
Yeah, it's. I would say that most people would say, so equity premium is the most reliable premium, and illiquidity premium might be the second most reliable, because it's so intuitive that we should get compensated when we lock in money for a long time. But so again, I mentioned that within equity markets, the evidence on illiquidity premium, small cap premium or many other premium is not really robust at all. So that's something. But the more interesting thing is maybe with private assets. So there, the illiquidity premium is often taken almost as a matter of faith that I lock my money, I will get compensated. Well, the evidence actually isn't so good. So my two favorite examples are that if we take the longest history that I know of for this, which is in US real estate, we can look at 40 years of REITs, listed REITs markets versus direct real estate. Turns out that REITs have outperformed. So there was inverse illiquidity premium. And maybe if you explain with leverage and sector compositions, you get that to zero. But there was, again, no sign of illiquids outperforming. And then when you look at private equity, where we have 30 years of data on US buyouts, 35 years maybe, there is some evidence. There's sort of 3% outperformance over S&P 500, but much more modest outperformance over that history against small cap value or leveraged equities. So really apparently modest illiquidity premium. And actually, when you look at last 15 years, again, there seems to be almost no outperformance. So surprisingly modest empirical evidence, unless you get the top quartile managers, which changes the story. But if you look at overall industry, then there isn't much of that illiquidity premium. You really need to get it from alpha. And then the question is, why not? There are many studies that look at sort of the, not what you realized, what was the realized illiquidity premium, but they talk about what's a fair illiquidity premium, what's a normative premium, how much should you demand when you lock money for 5 to 10 years and can't rebalance. So there are many logics you can do this. And those studies come up with several percentage points, 2%, 4%, 6%, whatever it is. And again, I think it's something more modest. And my best way of reconciling the evidence that there's surprisingly modest illiquidity premium in private assets is that there's another feature of private assets that offsets it, the return smoothing feature. With privates, whether it's private equity, real estate, private debt, so you don't have mark to market. And it's so nice to get those smooth returns. It really helps you stay as a patient investor, act like the long horizon investor you want to be. And it is, so it's really, I think it is a helpful feature for investors, but investors shouldn't then think that this nice comfort comes costlessly. It really comes, I think, in us collectively overpaying for that smoothing feature. So if there is something like, let's say, if there's a 5% illiquidity premium that would be fair for locking your money for the next decade, maybe you are going to get half of that or quarter of that. We don't know, the data is so bad, but you are going to get something less because this overpaying for that smoothing service offsets much of that fair illiquidity premium. So that's certainly the story, I think, is pretty reasonable sounding, and it explains this puzzling thing that actually when you look at data, there hasn't been too much outperformance of those private assets compared to public, whatever most people think. I mean, this is sort of partly clouded by lots of marketing and opaque data in private side and so on. So IRRs versus actual returns and so on. So I won't go there, but again, evidence modest, and my story is smoothing service is the butler did it, smoothing service did it.
No, it's very interesting. So, investors are paying for the privilege that their private equity manager can tell them that they lost nothing during coronavirus, isn't it?
Yeah. By the way, there is just one detail which is, I think, interesting. So private equity managers are allowed to decide on the marks for their companies about, depends a bit, but let's say 4 weeks later than the month end, a quarter end. It's typically. So think of last spring. They didn't have to make their marks at the end of March when things were a little fuzzy. They could make their marks, and this happens every quarter, 1 month later. And by then they knew that this is a bullish environment, so they could make more aggressive marks. And there is some academic research which tells that there is smoothing, and there is basically private equity managers use information from the next quarter to decide whether they make aggressive marks or conservative marks. And so that's that's this smoothing feature in action. Again, I do think that investors get some benefits from that. They can breathe more easily, whatever. But maybe stay more patient. There's something good in that. But don't then think that you are going to get the full illiquidity premium in addition.
Perfect. So switching topics slightly to the risk side of your work. So how do you think investors should incorporate sort of event risks such as the recent US election, for example, into their investment process?
Yeah, well, it's one thing for discretionary investors; they can do what they want. But I'll answer for a systematic investor. For some events, there may be enough data that you can sort of be opportunistic. So you could study what kind of patterns there are around elections. Is there something that you can do? But often you don't have enough data, and so you can't do too much with that. I think the more important thing is just to be more humble, and actually there's going to be some discretion that may be needed. So what we tend to do is we look at our risk metrics. So if we have got backward looking volatility and correlation metrics, we know that they are not going to recognize the event until it has happened. So it's very important to try to look at implied volatilities and so sort of forward looking risk metrics. And actually, then we would have a risk committee which is going to study, do we think that the metrics that we see there, they capture the election period uncertainty, or another one, Brexit type of votes or so. So for these times, is this enough? And do we basically have for our strategies, Do we have a system where we are reducing position sizes naturally with that higher volatility? If not, there may be basically a guidance to reduce position sizes if we think that there is a predictably greater risk coming than our standard analysis would say. So it's really, don't try to forecast what's going to happen, rather try to just have less risk to recognize the exceptional environment ahead.
And what are your views generally on sort of hedging or directly hedging equity market declines?
Yeah, okay, so this is an interesting one. So hedging is that's tail hedging, tail insurance, tail protection. And so first, I do think that for most investors, the equity market directional risk is most important risk in their portfolio. So they have to calibrate that well. And you really don't want to sort of sell at the bottom after you've sort of gotten disappointed. So you want to think ahead, do I have sort of suitable amount of risk taking in the portfolio? And maybe it can involve sort of calibrating that may involve having somewhat less equity exposure, or you may want to hedge by buying or insure by buying some put options. That's a direct hedging you were referring to. Or you may use some indirect hedging strategies, defensive equities, treasuries, gold. Actually, our favorites tend to be trend following and macro momentum type of strategies, which all tend to do relatively well. They are not as direct and as obvious as the put buying, but they have historically had quite a good track record with those events. And there's also a difference between whether there's some very sudden event, like what happened this spring, or more gradual bear market, as we saw, let's say, 2000 to 2003. So the trend following, for example, would do much better 2000, 2003. Put buying would disappoint pretty much there, and vice versa. It can happen with the faster one. So you want to think about the fast versus slow and maybe get protection for both. But so my big question about, or perspective on this one, is that what can investors stick with? In general, a good strategy for investors is something that you can stick with. And again, not something where you throw in the towel after the market fell. And and I worry with those put buying strategies or direct tail hedging strategies that the cost of put buying in good years is so big that investors will bail out before they get the reward. And so they capitulate after 2018, 17, 19, whatever it is, but they won't have those positions in 2020. And so, and I would have, so I've had some public debates then with Nassim Taleb on it. It was already 8 years ago in Financial Analyst Journal, happened again this summer. And so his original story certainly was that, you can get the protection pretty much costlessly. And I said that you look at theory and you look at the data, and it says that this is going to cost. This is the most valuable insurance that investors can have. It makes sense that insurance is going to be costly, and you are going to basically have negative long-run return. And then if I show 35 years of data, which is the best we can do with index options, it shows basically a sawtooth pattern down. I should show it from this side. So you do lose quite a bit of money in the long run, but you make money. To be fair, you make money when you most need it. So, last March or 2008, October 87, some of these ugly times, those puts come and help you when most needed. So that's wonderful. But that's also why investors tend to overpay for that type of super valuable insurance. So you shouldn't expect it to be costless. So again, the empirics then say that's very negative long-run return strategy. And then since it can last a long time, there was really 10, 11 years of bleeding between GFC and 2020 for these strategies. How many investors would have the patience when they lose 90% or more of the money they allocate to these strategies through that time? It is too common to bail out. So again, you have to have a strategy where you can stick with. And I do think that strategies like I said, trend following, treasuries, macro momentum, etc., defensive equities are important. They all have at least zero and likely positive long-run return, and that suggests that they are easier to stick with. Not necessarily easy, but easier than this put buying. So they are my favored ways of trying to help out in against the big equity market drawdowns.
Perfect. So a popular topic amongst our clients is always gold, and I'm sure probably with many investors who watch CNBC or Bloomberg, there's always someone with an opinion on it. Cam Harvey from university had an interesting paper where he showed that even though gold holds its value over the very long term, and he mentions a Roman centurion's salary in gold is comparable to an army captain's today, a US Army captain. But he also suggests that the gold price in the short term tends to be more correlated with flows into gold ETFs than it is to inflation, for example. So appreciate you normally invest in more diversified portfolios, but do you have a view on gold as a good hedge, and if so, what is it a good hedge for?
Yeah, that last thing is very good. By the way, first that story from Rome today, and so it pretty much means zero real return. So it's good for for safe haven. Zero is probably good, but it's not positive long run return. So you are, in some sense, you are giving up something. And of course, the way you give up is that you are not earning some cash on that, and that's why it has to rise in price over time. Okay, so that's just one observation there. But then regarding the safe haven qualities, so it can hedge against equity falls. It can hedge maybe against inflation and some financial crisis. So there are many ideas what gold can hedge against. And indeed, there is some. So it's sort of a jack of all trades, which means that it's not a master of any. So I found that, let's say, if I look at the 10 biggest equity drawdowns, gold did well in 7 out of 10. So it missed 3. If I look at some big inflationary episodes, if it's an inflation driven by weakening central bank credibility, which is maybe a relevant worry for the future, then gold should be doing well. But if it's something related to strong growth, sort of demand pull inflation, or China growth pushing global inflation up, or energy-driven inflations that dominated 1970s and 80s, it's not obvious that gold will do well in those situations. So therefore, it really matters what kind of fall we have in equity markets and what kind of inflation we get. But overall, I would say that it has got some safe haven abilities, but it's you have to watch out. And one particular thing that has been recently raised is that maybe you should replace government bonds with gold, because government bonds have got now so low yields, and there's some positive relation. So basically, gold prices tend to go up when real yields fall, and that sort of is related to the opportunity cost. But I'd be very watchful there because again, if gold has got some inflation sensitivity, it's basically gold likes rising inflation, whereas bonds like falling inflation. You are making a big inflation bet when you are replacing govie bonds with gold. You are making basically an inflation bet, which is fine, but it's not really hedging something the same, something like govie bonds are doing. You are totally leaving yourself open to some deflationary shock. Only govie bonds tend to help in those.
Perfect. And you touched on sort of the macro side and in terms of recession, etc. And obviously this year has been very interesting in terms of macro data and outliers on unemployment, things like that. So for sort of armchair economists who monitor the macro side, how should they translate that into their portfolio, and if at all?
Yeah, so I think for systematic investors, in some sense, it is harder because you have to really not take a view of what's going to happen, but you should look at some historical patterns that exist, and we don't know which way things are going to go. So if you take a view now that it's going to be either inflation or deflation, or it's going to be you can take a strong view on growth either way from here, and then things are easy. I do think that for systematic investors, perhaps the best thing we can offer is to try to come up with a portfolio that are robust across different scenarios. And so we would say that we really don't want to take an aggressive view on growth up or down, or inflation up or down, and we want to look for a nice diversified package that's going to be helpful and sufficiently robust that you can survive all of those scenarios. I think that's the best way to deal with the uncertainty here. If somebody has got this wonderful crystal ball that you can take, then try to get some added value there. But I would still say that actually the first thing you should do is to make sure that you survive in all of those scenarios, and then you tilt away from that based on your forecasts. Maybe one more thing I say on macro is that, so one thing is anticipation, but the other thing is sort of following the trends, and it's sort of surprisingly good performance that you get by following asset return trends, so typical trend following, or macro trends we call macro momentum. Both of those are sort of not trying to anticipate what's going to happen, but then follow. And the idea is that if things are happening in a relatively gradual fashion, you want to ride that wave there then. And again, in some situations, if things happen very fast, like last February, March, it may not be useful. But if things are slower, and especially I do think that inflation and rates development tend to be more gradual. I think with those, playing trend following and macro momentum are particularly good approaches. So don't anticipate, but rather go with the flow. Then that has been historically a successful strategy, helping sort of overdo the balance that I was saying. So outperform the balance based on just simple asset class exposures.
Perfect. Unfortunately, we are coming to the end of our time now, so I'd sort of close with a couple of off-the-cuff personal questions. So, what are some of your favorite books that you've been reading, especially during the lockdown period?
Yeah, well, overall I read a lot of obviously some finance, but also history and psychology and so on. I mean, I went and listened again to Daniel Kahneman's classic book on behavioral stuff. I tried this the Chinese three-body problem, which was very interesting, little scary, but extremely interesting. Hilary Mantel's. I sometimes go for this. These are all really big things, and So those actually, like one thing maybe I'll tell is that, so I'm a voracious reader, but last few years I've also done a lot of audiobook listening, and I love the efficiency of doing it, while I'm doing something else, sports or commute or whatever. But I recently heard this idea that you don't want to be always on the input mode. You need to give your mind some time to wander, and that has sort of made me feel guilty about my quest for efficiency here and multitasking. And so I'm trying now to sort of change my style. And at least, I mean, I do still use the audibles and so on, but I try to keep some time through the weeks then to let the mind wander and sort of be creative maybe then, rather than in the input mode.
Fantastic. No, there's a Netflix series I think coming for Three-Body Problem, but I've yet to read it. I've heard it's fantastic.
I couple of years. They just announced it, so we'll have to wait.
Fantastic. Yeah. And just finally, sort of what advice would you give to individual investors who want to better understand quantitative investing?
Well, read a lot. Instead of trading, don't trade too much because overconfidence is not so great. But read a lot, and maybe like I was so like my favorite. I do like my book. There's Andrew Ang's and Lasse Pedersen's, my colleagues. Their books are very good, but maybe they are not good for first books or early books. So if somebody is not so experienced, then there are nice books by Bill Bernstein, Larry Swedroe, and in this last year I wrote two quite nice books. Daniel Crosby, Behavioral Investor, and Brian Portnoy, The Geometry of Wealth. So these are just like I'm trying to find ways of how to communicate better, and I find that have to go back to basics, and these have done very well the basics.
Fantastic. No, Antti, thank you so much for your time today. It's been a brilliant conversation, and thank you to our audience for sparing the time today. So for everyone, keep well until next time. And
thank you. Enjoyed.